Time now, let's go to the key interview of the week, and I've got Tyler Bolhorn on deck with me. He's the founder of StockScores.com. Tyler, great to have you with us. First of all, thank you for taking the time, but I want to get right into it, and just give me a quick overview of what you see in these markets right now.
Well, let's start with the U.S. markets. I really think that they are beginning to price in a Fed rate increase. The month of October, we had this unbelievable amount of low volatility and whipsaw market. Up a day, then the following day we're down, and then the next day we're up, and then the following day we're down. It was really, as a trader, it was actually quite frustrating because there was no trend, there's no opinion. Investors are sitting on their hands with memories of the last time the Fed raised rates, and of course we had a pretty good sell-off on the heels of that. And so I think the U.S. market is gripped in indecision, and of course you have the U.S. election, the circus that comes with that. So U.S. markets beginning to show that weakness. We had the breakdown in gold a few weeks ago. This week, the small cap stocks broke their upward trend line, and the S&P has not yet done that, but it's building pessimism slowly with that very low volatility environment. So I'm really cautious about U.S. stocks right now. I think you have to be very careful going into December.
What about in Canada?
So Canada actually, for a long time, has underperformed, and it's actually been outperforming the last little while, and it really doesn't look as bad as the U.S. market. Not that the U.S. market looks bad yet. I just think it's a cautionary situation. But the Canadian market is actually looking pretty good. Bank stocks are doing well. I like the telecoms. They're yielding quite high yields for what they are, BCE and TELUS. So the Canadian market doesn't look all that bad. Now, of course, for foreign investors, the Canadian dollar is moving lower. So you're kind of losing in that regard. But for us Canadian investors, I think that the Canadian market does look better, but if there's going to be weakness in the U.S., then that could spread to Canada. So I still think you have to be cautious everywhere you look.
I was reading the other day, and it's how the investment world has changed, and how people are going to. I look, for example, at the best performing funds right now. All use sort of these quantitative approach or the algorithmic approach, easy for me to say, as you can tell, but using basically computerized trading.
Yeah, that's really the dominant force. Half the volume traded on the New York Stock Exchange is executed by a computer. The top performing funds over the last few years, Citadel, Renaissance, these funds are not driven by human beings. They're driven by computers. Now, the computers are being programmed by humans, but it's not finance people programming them. It's mathematicians and computer scientists, statisticians. That's the way the market is. So what it has done is, number one, made the market very efficient, and number two, really for the investor who approaches the market with their intelligence and saying, well, it would make sense to buy such and such a company because their earnings are growing or that sort of thing. That's not always the case. These computers are playing a lot of games with how the market trades, and you have to understand what they're doing and trade accordingly.
Give me an example. Is that instructive at all for individual investors? Obviously, these strategies, the computerized strategies, they are recognizing patterns. They're, and they're trying to scalp it on that basis, and that's why they use the computer modeling. What does that mean to an individual, though? Well,
I think a lot of people approach the market with the idea that I have to be smart. And so they'll say, okay, well, I've looked at such and such a company. They've got great management. They've got earnings growth, all those sorts of things. That's great, except that because the market is incredibly efficient because of the computers, that information is already priced in. There's computer algorithms that do nothing more than look at news releases and look for keywords in those news releases and buy and sell the market accordingly. The market reacted unbelievably quickly to the news that Hillary Clinton had some new email problems on Friday.
Yeah.
That was the reaction was far quicker than any human could do. And the reason is you have these algorithms looking for these keywords in news releases as they come out, and they react in a microsecond. So the point is, if you are, as an individual investor, trying to use information, you're 20 steps behind the computer, which is already priced in that information. And by the time you think, oh, Hillary Clinton's got some bad emails, I'm going to short the market, well, the market's already moved down on the news, 6 minutes prior to you thinking about that. So I think what you have to do then is do what the computers are doing, or at least follow the computer by looking at market activity. And that's what I do. I look for abnormality in market activity because I know that if I'm trying to be smart and think about, information as it comes out, I'm too slow. I have to look at what the market's reaction is, and that's ultimately driven by the computer, and then trade off of that. So, looking at the market on Friday, I was watching the market. Obviously, I do that every day. All of a sudden, you saw this selling pressure come into the S&P, and then the volatility index spiked. I have no idea what's going on, but that right there was telling me something was up. And, I ran a little chat room during the day, and I said, guys, there's something going on. What's happening here? And then you learn about it 10 to 15 minutes later, why it's doing that.
That's such a key point, though, that you're bringing forward, and that is, people who think they're going to outsmart the market, you're just not first in line when it comes to information, and then, as you say, acting on that information, and it puts us at a disadvantage. And I'm just wondering, okay, so how do we turn that around and use it, if you know what I mean?
Right. So the computers are going to price in the information very quickly, and they will tell you what to do. So let's use an example of Netflix from, a week and a half, 2 weeks ago. I'm watching the market. All of a sudden, Netflix has a good spike on the open in price action. Its earnings are due out a week later, maybe 10 days later. So I see that. I don't know anything about Netflix. I mean, my wife watches Grey's Anatomy on it. That's about my extensive knowledge on the company. But I could see the price action was abnormal. The volume coming in was abnormal. So I bought Netflix. Then, again, let's say it's 10 days later. I can't remember the exact time frame. But 10 days later, earnings come out. They blow the earnings expectations, and more so with their growth of users. The stock spikes up. From that time that I saw it at around $103, I think today it's at 128 or so. You're looking at almost a 25% gain in a week. And I don't know anything about Netflix. But what I know is that the people that know the most, or should I say their computers, they are pricing in expectations based on great research that they're doing, great research that you and I cannot do. We don't have the resources or the information sources. And they're pricing in that information. I just follow them. I don't be smart. I just trust what the market is telling me. And sometimes I'm wrong, and so I'm going to take small losses when I'm wrong. And, I've always got risk management methods in place. But when I'm right, because I'm following the smart money, the well-informed money, then it works. Boeing, another great example. The market predicted the big jump that we saw in Boeing this week. It all begins with abnormal trading activity.
Absolutely fascinating stuff, and I just want to let everybody know that at the end of the show today, if you go right on, you got to log into moneytalks.net. Tyler's going to be doing a webinar which is going to bring visuals to what he's talking about here, using these kind of trading rules and how you can really try and bulletproof your approach to it, pardon the cliche, but also take advantage of exactly what he's doing. It's absolutely fascinating, but I got to tell you, only 500 people, by the way, can participate on the platform that we're using, but it's easy. It's starting right after the show, immediately, like 5 minutes, wherever you're listening in Calgary, it's 11:05, or in Vancouver, it's 10:05 a.m. Just go to moneytalks.net and you can see it right there. But I mean, this stuff is absolutely fascinating. Give us an example like Netflix. And it's very understandable. The news comes out after the fact, that you're identifying it before that. So you're not chasing the information. You're just reacting to the markets. And I think that's absolutely fascinating. We'll be back. I got to take a break, though, Tyler. I'll come back. Tyler Bolhorn. You can find him, stockscores.com. More on the Money Talks Network. If you've been following the U.S. election very, very closely, I still have a shocking stat for you, and it's a fun one, but it's a shocking stat on the U.S. election about the two candidates. But right now I'm having the pleasure of talking to Tyler Bolhorn, who is the founder of StockScores.com. A lot coming, one of the things that I love that you bring forward to the public, Tyler, is that you talk about rules-based investing. And that's what we're going to talk about in the webinar right after the show. But, I mean, it's just such a key. And I thought maybe we'd come back very quickly. And, an example might be, when you buy a stock that has 4 consecutive quarters of earnings growth. So that would be taking a piece of information. Give me an example, like if you were doing trading off of technicals or economic indicators.
Sure, and by the way, I often talk very short-term, but you can do very long-term examples as well. So, a short or medium-term technical approach would be to say buy when Price closes above the 10-day moving average after being below the 10-day moving average for at least 3 days. Now, I'm not saying that's a good strategy. I'm just using as an example the kind of thinking that we do. As a longer-term approach, you might say, I'm going to get out of the market or short the market anytime the yield on the 2-year U.S. Treasury rises above the yield on the 10-year. That's an inverted yield curve. And that has actually predicted virtually every recession in the past 50, 60 years. So a very reliable, very long-term indicator just to tell you when to get in and out of the market. So those are kind of the way we think about things. You know, if I'm day trading, I might say I'm going to look at any stock that's trading statistically significant abnormal volume today and then watch those stocks if they break a pullback from a high. That's something I do on an ongoing basis, and I'll talk about that in the webinar today as well.
Yeah, so you base your approach, though, on looking, just being a detective, an observant one at least, looking for abnormal price or if a volume all of a sudden spikes, that kind of stuff.
Yeah, and, you know, statistics. What I've done is I've spent, hours and hours, years and years of looking at correlations between things. I don't try to do anything more than trust the statistics. So if I have an idea, I test it. I look over a large number of trades over a wide variety of market conditions and look to see whether the idea makes money out of 100 trades. I don't care whether it makes money 1 or 2 times. I want to see out of 100 trades, this strategy made money 62 times, and it made me the profit that was double the loss when I was wrong. And that would be a strategy that has a positive expected value. And ultimately, I'm trying to be like the Las Vegas casino, put the odds in my favor. You know, the people playing blackjack in Las Vegas, the odds are against them. The odds favor the house. And so I approach the market wanting to be the house. I want to always have probability in my favor.
You know, the webinar you're doing right after the show is called Rules-Based Stock Trading, the steps to trading like a computer. And I guess you'll get a chance, this is just fascinating stuff, you get a chance to go into it in depth, obviously with some visuals there. All you have to do is go to moneytalks.net to sign in. Only 500 will be able to get in, by the way. Hey, just before you go, Tyler, we started off by getting your take on the U.S. and Canadian stock markets. If you don't mind, I want to break it down a little bit, what you're seeing, for example, in the gold market.
Sure. So gold broke its longer-term upward trend a few weeks ago. It became oversold, though. So one of these algorithmic strategies that's employed is something called mean reversion, which means if stocks or industries or commodities, for that matter, get too far away from their average, they will bounce back. So I've been writing for the last couple of weeks, and in the videos I do every week, that gold is oversold. It will probably bounce back or at least go sideways for a little while. However, having said that, the damage is done. The upward trend has been broken. And so although we're sort of creeping up these days, I expect that trend will roll over and head lower again. And so I would be very cautious with gold unless it can break the pullback that it is in right now.
A quick take on oil.
Oil has been basically locked in a trading range for some time. You can see that trading range. We're starting to see a little pickup in pessimism. We broke through some, I would say, short-term support zones late last week. And so I think that we could see a creep lower, but I don't see considerable downside yet. It's more that it doesn't look like it wants to go higher as opposed to being really bad. I think it's relatively stable, but again, I think caution warranted because it's starting to show a little bit of trepidation, and it makes some sense as we move closer to OPEC deciding how much they're going to cut or if they can even cut or whether countries will be compliant. All of those risk factors, I guess, are starting to be priced into the market. You're seeing that in how oil is trading.
And I want to save the last one for, Key. You alluded to it earlier. You're looking about the impact of U.S. raising interest rates, but I've been looking at the charts, for example, of the 10-year bonds in the States. To me, it looks like they're breaking down. And just wondering what your take is on the bond market.
Yeah, well, the bond market went parabolic, say 2 months ago. Now, when markets go parabolic, that's usually, and by parabolic, I mean it went up very, very fast, exponential rise in bond prices, which meant that interest rates were going down. And that's typically what happens at the end of a bull market of something. We then saw that breakdown, and since that time, we've been breaking through key support areas week after week after week. This past week, we actually saw a pretty substantial breakdown again. So we've gone through steep trend lines, and we're slowly approaching the more shallow trend lines. And I think that you have to be very cautious with the bond market. It looks to me more likely to go lower than higher, which means interest rates going up, which means the market expects a rate increase in December. I actually think that will be somewhat good for stocks longer term, because I think it takes away the uncertainty of when are rates going to go up. But short term, I definitely think that it's a risk factor, and that's why I'm very cautious right now with all of these things, stocks and bonds.
Yeah, it's a fun environment. Let's just leave it at that. No, with a lot changing. And that's why, as I say, I invite people to go to the webinar after the show. It's at 5 minutes after we're over. Excuse me, Tyler starts. Just go to moneytalks.net for a lot of reasons. By the way, great articles up there, one by Martin Armstrong with us. We got the daily business comment, but also today you can click right there. Rules-based stock trading, the steps to trading like a computer. Tyler Bolhorn will be hosting that. Great stuff as usual. Thank you for finding time, Tyler.